Hello and welcome. In this presentation, we will explore flexible budgets and how they are used for performance analysis. We'll learn how to move beyond simple static plans to create a more dynamic and meaningful evaluation of a company's performance. The goal is to conduct a true apples-to-apples comparison of our results. Here is the journey we will take today. We will begin with a case study introducing Rick's hairstyling and his static planning budget. We'll quickly see the problem with this type of budget, which often leads to an apples to oranges comparison. We'll then discuss the goal of performance analysis by understanding the variance analysis cycle. The solution to our problem will be the creation of a flexible budget, which serves as a dynamic benchmark. With this tool, we will perform a variance analysis, isolating both activity and spending variances. We will then discuss how to take action on these variances using the concept of management by exception. And finally, we'll touch on an advanced topic, using multiple cost drivers for even greater accuracy. Let's begin by meeting Rick, the owner of an upscale salon. At the beginning of March, to better guide his operations, he prepared a planning budget for the month. As you can see, his key assumption was that the entire budget would be based on a single level of activity, 1,000 client visits. Based on his revenue and cost formulas, such as revenue of $180 per visit and fixed rent of $28,500, he expected a net operating income of $16,800. This static budget represents Rick's baseline expectations before the month began. Now, let's look at what actually happened. At the end of March, Rick was happy to see that his actual net income was $21,230, which was significantly higher than he had planned. But when he created a simple report comparing his actual results to his planning budget, he became very confused. While the good news was that his net income was over $4,000 higher than budget, the bad news, or so it seemed, was that most of his expense variances were labeled as unfavorable. For example, his wages and salaries were $4,900 over budget. Rick quickly realized the problem with this report. It was like comparing apples to oranges. Of course, his costs were higher. His activity level was also higher, with 1,100 actual visits compared to the 1,000 he had planned. This type of comparison isn't meaningful for truly evaluating how well he controlled his costs. Before we fix Rick's report, it's important that we understand the goal of this entire process. The purpose of variance analysis is not to assign blame. Instead, it is a tool to drive a cycle of continuous improvement. As you can see from the diagram, the cycle begins when we prepare a performance report. From there, we analyze the variances or the differences. This leads us to raise questions about why these variances occurred. The next step is to identify the root causes of those variances. Based on that, we take action to either replicate our successes or eliminate the sources of poor performance. We then conduct the next period's operations, which generates a new performance report, and the cycle begins anew. So, to solve Rick's apples to oranges problem, his accountant, Victoria, creates a flexible budget. A flexible budget is not a new plan. Instead, it takes the original budget's formulas and recalculates what revenues and costs should have been for the actual level of activity. In this case, the flexible budget is prepared for the 1,100 client visits that actually occurred. For example, the revenue in the flexible budget is calculated as 1,100 visits times the budgeted $180 per visit, for a total of $198,000. Similarly, the wages are recalculated based on the 1,100 visits. This new budget, which shows a potential income of $30,510, is the fair apples-to-apples benchmark that we need to properly evaluate performance. The first question we want to answer is, how did the change in activity affect our profit? To answer this, we compare the flexible budget to the original planning budget. The differences between these two are called activity variances. This comparison isolates the impact of the change in business volume alone. For example, the activity variance for revenue is $18,000 favorable. This is because having 100 extra clients should have generated exactly $18,000 more in revenue at a rate of $180 per visit. Looking at the bottom line, the $13,710 favorable activity variance for net operating income tells Rick that simply being 10% busier should have increased his profits by that specific amount. The second question we want to answer is, given how busy we actually were, how well did we control our costs and revenues? To answer this, we compare the actual results to the flexible budget. This is a true apples-to-apples comparison because both reports are based on the same level of activity, 1,100 visits. These variances highlight issues with efficiency, pricing, and cost control. For example, there is a $3,800 unfavorable revenue variance. This means that for the 1,100 clients Rick served, his revenue was $3,800 less than it should have been, perhaps due to offering discounts. We can also see a $1,300 unfavorable spending variance for employee health insurance, which means Rick spent more than he had planned for that item, even after adjusting for the higher activity level. This is something that warrants investigation. Now that Rick has this meaningful report with all these variances, where should he focus his attention? To avoid getting lost in the data, managers use the concept of management by exception. This is a system that compares actual results to a budget so that only the significant deviations or exceptions are flagged for investigation. This allows managers to focus their limited time on the most important issues. So, how do we define a significant variance? We look for a few things. First, the absolute size. Is the dollar amount large enough to matter? Second, the relative size. Is the variance a large percentage of the total spending for that item? And third, the pattern over time. Is a small variance recurring and growing steadily each month? This could signal an emerging problem that needs attention. For even greater accuracy in our analysis, we can use a flexible budget that incorporates multiple cost drivers. For some of Rick's costs, the number of client visits might not be the only thing driving the expense. For example, Rick's accountant realized that some costs, like wages and electricity, likely depend more on the number of hours the salon is open than just the number of clients served. As you can see in this more refined model, a new flexible budget has been created that uses two cost drivers, Q1, which is the number of client visits, and Q2, which is the hours of operation. This provides an even more precise benchmark for performance evaluation because it more accurately reflects the business's underlying cost structure. Let's summarize our key takeaways. First, performance evaluation should be part of a cycle of continuous improvement, not simply a tool to assign blame. We've learned that static budgets are useful for planning, but they are poor tools for performance evaluation if the actual level of activity differs from the plan. Flexible budgets provide a dynamic benchmark by adjusting to the actual level of activity, which enables a true apples-to-apples comparison. Variance analysis helps managers separate the impact of changes in business volume from issues of spending and efficiency. And finally, management by exception helps managers focus their limited time on the most significant variances to have the greatest impact.